I'm Jenny Brown. Welcome to our weekly buy-to-let mortgage market update. I hope everybody's keeping super well. I had my first COVID jab over the weekend. I'm recovered now. I have to say I was a little bit poorly straight afterwards, but nothing too dramatic. So for those of you who are going through the jab experience, I hope it's not affecting you too much and you're recovering very speedily. In terms of what we got for you today, lots more lender news. Again, all really positive changes. I'm also going to run through the information setting out the launch of Capital Home Loans, who are delighted to see return to market after some 13 years. And then we're also going to cover off some landlord feedback. I know as a landlord it can be quite an isolating experience. You're kind of working by yourself. You don't necessarily have loads of landlord mates to bounce ideas off of and see how they're feeling. So we've got some market data from landlords across the whole of the UK with varying size portfolios who have really fed back about how they're feeling about things at the moment and their plans for the near term. So we're going to be sharing that with you as well. Landbay have made some reductions to their pricing in the last week. So they've made a reduction of 10 basis points on their core 75% loan to value range. So they have 2-year fixed rate pricing now starting from 3.19%. And I should just add here, this is available for both limited companies, SPV limited companies and individuals. Landbay do lend to trading companies but have a separate product set for that. They've also brought out a new 65% loan to value product, which is a 2-year fix, which is at 2.99%. So very competitive pricing there. Now they've also made reductions of 10 basis points on their 2- and 5-year fixed rates for small HMOs and multi-units. So rates there now start from 3.49%. And just to confirm that in Landbay's world, a small HMO has 6 rooms and a small multi-unit has 6 self-contained units. They are able to lend on HMOs up to 12 units and multi-units, so HMOs up to 12 rooms and multi-units of up to 12 units. But that falls within their larger property product. So in terms of Landbay and who they're looking to lend to, they really do embrace the professional landlord. They don't mind how many properties you have in the background. Now they do need you to have £25,000 a year worth of income. This does drop to £15,000 per year if you've got more than 2 years of landlord experience. Now their rental coverage is pretty generous. It's 140% coverage at 3.39% if you're borrowing personally, or 125% coverage at 3.39 if you're borrowing in a limited company. Now I should just add here, that starts from that calculation, so that's the most generous calculation that they offer. Now they need your background portfolio, for those of you who are portfolio landlords, to cover itself at 125%, assuming a notional rate of 5% across the board. Which actually, in terms of the market, where does that sit? It's not bad. It's probably on the more generous end of the scale, but not the most generous, but it's fairly flexible. Now they're able to accept applications from people aged 79 years or younger. If you're 79 years, you can have a 5-year term. They've got some niches in terms of the property types they accept. They're able to accept properties where the lease will have, the leasehold will be no less than 55 years at the end of the term. So essentially you can apply for a mortgage with a property as lease as low as 61 years. They accept studio flats with a minimum square meterage of 30 square metres. And they are able to accept properties in high-rise blocks, and their definition of high-rise is anything more than 5 stories, but they are going to want an EWS1 to be in place. The other thing about Landbay that's quite cool is they do accept remortgages within the first 6 months of ownerships, and they're able to accept students, professional tenants, company lets, housing associations, as long as they're 3 years or less, the sort of term of the lease, and also DSS tenants. So a really solid offering there from Landbay, and so really good to see them reduce their pricing across their board as well. Foundation have gone through a series of repricing in the last weeks. They've reduced rates by up to 20 basis points across some of their products available to up to 80% loan to value. Now they've also introduced some new 2- and 5-year fixed rate fee assist products for purchases and for remortgages. So with these products, there's a fixed arrangement fee of £1,495, so no percentage charge fees here. And these products tend to work particularly well for larger loans. Now they have two sets of pricing brackets. They have rates up to 65% loan to value and some at 75% loan to value. And on these particular Fiercest products, they are offering a free valuation. There's no application fee and you do get £250 cash back. Now they've also introduced new fixed fee products for their HMOs and multi-units, again with a 1495 fee. So that's really competitive. They have an appetite to lend on HMOs of up to 6 rooms and multi-units of up to 10 self-contained units. And all of these are available for limited companies and also for individuals. So in terms of who is a foundation borrower, they don't mind how many properties you have in the background. They don't have a minimum income requirement. Interestingly, for limited company applications, there is no maximum age limit whatsoever, which is really, really cool. Now, in terms of background portfolio and stress testing, the background portfolio needs to wash its face at 125%, assuming a notional interest rate of 5%. And their most generous rental calculation they have available at the moment is 125% coverage on an interest rate of 3.09%. And this is a limited company product. But what this actually means is you can borrow up to 311 times the monthly rent, which is really, really generous in the market. Now this would work, I think, particularly well for those properties which are higher value and lower yielding. So you'll find on the more standard rental calculations, 125 at 5.5, that kind of thing, you would find that this product really works much more favourably for you in terms of gearing you up to the higher loan to value levels if you're struggling elsewhere. So look, in terms of property types, what do foundation home loans like? They're really good at properties with deck access, flats over commercial. They're very good at looking at anything which is over, I think, anything which is open late can be noisy or maybe has some smells, so restaurants, bars, off licenses, convenience stores, that kind of stuff. We would need to refer those to them on a case-by-case basis. You'll find there's far more appetite for these kinds of properties if they're in a fairly prime location than if they're in a sort of second tier location. They can accept studios up to 30 square metres, and their requirement on leaseholds is the lease needs to have no less than 50 years left on it at the end of the term of the mortgage. So essentially the minimum lease term that they would accept is 56 years on application. Another thing that we really like about foundation is they are able to consider layered company structures. So once again, you know, a lender with a really, really solid offering that is incredibly landlord friendly for individuals or limited companies, bringing their pricing down. Now we're really, really happy because Kent Reliance have made some reductions to their products. They brought out a whole new series of products, which either in terms of the change to their previous offering means that you can opt for products with either a lower arrangement fee or a lower interest rate. Not both, I hasten to add. So what Kent Reliance have always done as a lender is they've always had a fairly small product set, which has always been really fantastic, but it's been fairly limited. So what I guess they've done is looked at their offering and kind of tried to bring out products which would appeal to various types of people. Some borrowers are incredibly focused on interest rates, okay, they just want the lowest monthly payment. Other borrowers really hate large arrangement fees, irrespective of the fact that if that large arrangement fee buys them a better rate overall. And some people are really interested in the blended cost of the two. It's the deal which in the round is most competitive for them. Now, you know, from our perspective, there's no right or wrong answer here, really. It's down to the individual's preference. But really, I think what Kent Reliance have done is looked at their offering and realised that actually maybe they're missing a trick in terms of meeting everybody's preferences and needs. So look, what they've done is they've now got rates from 3.24%, and they've also brought out different products where the arrangement fee is 0.5% of the loan amount. And these are all available to 75% loan to value. Now, in terms of Kent Reliance, in my opinion, in the specialist end of the market, they are, I believe, have one of the best offerings in terms of criteria and flexibility of underwriting. So, for example, they can accept multi-units of up to 10 units and HMOs of up to 10 bedrooms. They accept first-time landlords for HMOs and multi-units, but they cap the number of beds, bedrooms or units at 6. But they are one of the only landlords who will offer this to first-time investors. That's really good. Another thing about the Kent Reliance offering that I really like is they're only looking to take personal guarantees from the directors, so not from the shareholders. So this works really well for those people who have set up a company where the shareholding is a little bit more involved than simply husband and wife, or investor and business partner, where there's just a couple of you and it's a very, very straightforward structure. This tends to work really well for those people where they've got children as shareholders. Maybe if you've got people who are shareholders who you don't want them to have to provide personal guarantees, they're simply involved as a kind of investment thing, but they don't want to be offering up PGs because they're not involved in the day-to-day running of the business. I mean, there's lots of different reasons why this can work really well for people, but actually fundamentally it's a really nice offering. Now, another thing about Kent Reliance is they can offer loans of up to 75% loan to value, up to £3 million worth of borrowing, which again is very, very, well, it's very punchy actually in today's market. They don't have a minimum income requirement. You can be up to 79 years of age to apply for a mortgage with them. They don't mind how many properties you've got in the background. They will accept remortgages against full market value from day one, as long as you can really demonstrate how you've seen such an uptick in value from purchase. So, for example, you buy a property for £150,000, you spend a bit of money on it and suddenly it's worth £220,000. They're happy to accept that figure. And the other thing about Kent Reliance is they can accept top slicing as well. So if the rental income isn't quite working out, but you have lots of surplus personal disposable income, they can bring that into the mix when looking at affordability. The other thing I find with Kent Reliance that I really like is they take what I would say is a more pragmatic approach towards blips on adverse credit, particularly if you weren't at fault or it was merely an administration error. So say, for example, you missed a mortgage payment 18 months ago, but you had the money in a different account, you simply didn't transfer it, and by mistake you missed the mortgage payment but brought it back up to date the following month. They're the kind of lender who can actually take a view on this kind of stuff, whereas other lenders say, look, we can't accept any missed mortgage payments within the last 2 years, for example. So really, really solid offering from Kent Reliance. We really rate them as a lender, and they've brought out some really nice new products as well. Vida Home Loans have released a new fixed fee limited edition product with a rate starting from 3.39% with a flat arrangement fee of £1,995. Now, these limited edition products are available on standard properties and also HMOs of up to 8 bedrooms and multi-unit freeholds of up to 5 units. Now, Vida tell us that flats over commercial and ex-local authority flats are their speciality. So they are actually very good at that, to be fair. They are more open to flats over commercial than a lot of their kind of competitors. As with all these things, it's going to always really hinge on valuer's comments. So if the valuer goes out, it's a flat over a kebab shop, and the valuer is happy that that doesn't impact the saleability or lettability of the property, then Vida are going to be happy to support that application. Obviously, if the valuer goes out and says, this is going to be a real problem for selling the property, or it's going to really limit anyone ever wanting to live in this place, different conversation. Now, in terms of Vida, they have no maximum number of properties in the background. You can be age up to 74 to make an application with them. There's no minimum income requirement as well. They do have a really solid offering, and I think in previous weeks I have spoken about Vida Home Loans' service and how they were really struggling. Largely because they got bombarded with applications in the autumn and into Christmas, and they've been playing catch up but never really kind of broken the back of it. But I think it's fair to say that now they really are over the worst, and I wouldn't be fearful of applying for a mortgage with them by any means. It's good to see them bringing out some really competitive new rates. In the last week, we've seen West One change their maximum loan size to £750,000. That's an increase, I should add, up to 80% loan to value. And for loans of up to 75% loan to value, they can have a maximum borrowing now of £1.5 million. Now, West One have also increased their maximum loan on holiday lets to £750,000 and also increased their risk appetite for flats over commercial, and they're now able to consider these types of properties at up to 75% loan to value. What they have caveated is anything over a food outlet would be capped at 65% loan to value. TML have released a new limited edition 5-year fixed rate for individuals and limited companies. The rate is a 5-year fix at 3.56% with a 1% arrangement fee, and this comes with a maximum loan amount of £1.5 million. So you know what, in the limited company space, in terms of pricing, it's a really good product. TML are a really great lender. They're relatively new to the market. One of the things that I really enjoy about them is their service. They're really, really quick to get things through. So if you're looking for a mortgage in a hurry, particularly because we have this stamp duty deadline looming over all of us, they could be a really good option for you. Okay, so it's always really exciting when we have a new lender come to market, particularly when it's one who, in their heyday, was such a significant player in the buy-to-let market. And when I say heyday, I'm talking some 13 years ago. So we were really excited when Capital Home Loans announced they were coming back to lending. So they're now out, they're lending, they're live. They've given us the full lowdown on their rates and their lending criteria. So I just wanted to share with you really the kind of market that they're moving in and the kind of deals that they're looking to do. So look, first of all, Capital Home Loans are going to be lending to individuals, limited companies and trading companies. Now, what they have said is with trading companies, what they're really looking for is companies which are fairly simple, that don't have a lot of debt. It's just, probably something along the lines of a consultancy business where you've built up, good levels of retained profit and you want to invest those. What they're not looking to do is lend to sort of trading companies where there's large levels of debt in the background. Now, they can accept up to 4 applicants on any application. So if you're buying in your personal name, there can be up to 4 of you on the application. Now, when it comes to limited company lending, they're taking personal guarantees from directors and shareholders, which means there can be no more than 4 directors and shareholders to kind of make the numbers work. What they will do, though, is ignore one shareholder who has a share of less than 20%. So you can actually have it that you have 4 directors, but 5 shareholders, as long as that 5th shareholder, their shareholding is sub 20% of the share capital, then that will mean that actually they will just ignore that 5th person and therefore, it all kind of works. They have a maximum age or maturity of the loan of 85. There needs to be £20,000 worth a year of income between all of the borrowers. So if there's 4 of you, you can all earn, £5,000 a year. That would work, but there has to be across the board £20,000 a year income, and that can be from rental profit. Their minimum property value is £75,000 with some exceptions. For example, if it's flats over commercial, or ex-local authority, they do have a minimum property value of £100,000. As you can see, I'm reading from my notes here. They also are able to lend on HMOs of up to 6 bedrooms and multi-units of up to 6 units. They are looking to expand on this, but at the moment, while they're kind of just launch, that's where their appetite is sitting. And to get a mortgage with Capital Home Loans on either of these property types, you do need to have 2 years letting experience. Now, their rental calculation is good. They have a rent requirement for limited companies of 125% at 3.1%. So that's basically a pay rate product, which puts them in a good space. And one of the things that I really like about Capital Home Loans is they don't have a set legal panel as such. So some lenders, when you're borrowing through limited companies, they have a list of acceptable solicitors, and some lenders, they have only maybe 3 or 4 acceptable solicitors on the list, whereas others, the panel is really wide. And so Capital Home Loans are a lender who is saying we don't have a set panel of solicitors, but the solicitor that you deal with has to meet certain requirements. So yeah, look, it's very early days. We haven't actually done an application with Capital Home Loans yet, so I can't really vouch for their service, but actually in terms of their offering, they've come to market with something that's really quite solid. When you find you have a new lender who comes to market, and we've seen with some of the more recent entrants prior to Capital Home Loans, what you will find is that their lending policy starts off being relatively narrow, and then over time, as they kind of demonstrate that they're lending successfully and the kind of mortgages are getting paid on time and that their mortgage book is fairly low risk, the people who fund these lenders then tend to say, well, okay, we start to trust you to open up your criteria, and they give them almost more rope. So, I do think that Capital Home Loans will, be going on to much bigger things, but at the moment, in terms of a launch, initially, it's a really, really solid offering. Accord Mortgages have given their online application system a massive facelift, and aligned with that, they've also made some really significant changes to their lending criteria. So first of all, they're now able to accept top slicing. I'm guessing this was a system issue before where they couldn't do that, but they're now allowing top slicing. They've also expanded their criteria to accept properties in Scotland. They're able to lend on new build houses at 75% loan to value and new build flats at up to 65% loan to value. And they've also reduced their portfolio stress test. So when they're looking at the background portfolio, it now needs to cover at 145%, assuming an interest rate of 4.5%. So that's come down. They've also reduced a lot of their rates, so their pricing now starts from a really incredible 1.66%. Accord are a lender who are very much looking for landlords who have properties in their personal names. They don't want really people with property portfolios of more than roughly 10. They need you to have a day job away from properties, so income that's derived not from rental. But again, you know, that really does encapsulate so many landlords. So it's really great to see that they've really looked at their criteria, expanded it really quite aggressively, and also made some really fantastic reductions to their pricing. Now, in the last week, the Mortgage Works has published both its rental income analysis report and also its tenant demand report. And I always find these incredibly interesting because these are the reports which produce the findings of surveys from landlords, where we can really find out about what they're seeing is happening in terms of their letting business and really where their thoughts are about the future. So first of all, to cover off the rental income analysis report. So first of all, in Q1 2021, the average rental income from a gross rental income from a portfolio was £54,000, which is down £1,000 from Q4 in 2020. Now, the average rent that landlords achieve has been slowly trending downwards since Q4 2019. And of course, our initial reaction is to go, God, you know, rents are coming down, we're all doomed. But actually, what this is a reflection of the average portfolio size of a landlord, which has also reduced. So in Q4 2019, the average portfolio size of landlords responding to the survey was 8.9 properties, but this has now come down to 7.3 properties in Q1 2021. So naturally, if they have less properties, they're going to be generating less rent. So that's why we're seeing a continuous downward shift in terms of average gross rental incomes. So look, this means that the average rent per property now sits at £7,397. 21% of landlords that were surveyed increased their rent in the last 12 months, and 22% of landlords are planning to increase rents in the coming 6 months. Now, the highest gross average rental came from those landlords with properties in Wales, where they were averaging £69,000 across their portfolio. But it's also worth noting here that landlords with properties in Wales have a higher than average number of properties in their portfolio, sitting at 14.1 properties as average per landlord, rather than the 7.3 we see across the whole of the UK. So obviously, if they've got more properties, they're going to generate more rent. So most regions actually are getting above average yields. So Yorkshire and the Humber, the North West, the West Midlands, South West, East Midlands, South East and London are all areas where landlords are achieving above average rents. The North East and the East of England were the only areas where they were generating below average at £44,000 and £43,000 per year respectively. Now, in terms of the landlord surveys, 4 in 10 report a rising rent. 1 in 10 say that rents are falling. 3 in 10 are saying that rents are remaining unchanged, and the rest just simply weren't sure. The average rental yield on HMOs is now sitting at 7.5%. On multi-unit blocks, so blocks of flats, and essentially they're sitting at 7.1%. And the lowest yielding assets are currently flats and bungalows, both sitting at an average yield of 5.8%. Now, looking on to tenant demand, so 31% of landlords felt that tenant demand had increased in the last 3 months. 29% of respondents simply weren't sure, 25% of respondents reported no change, and the rest were seeing a fairly slow, decrease, Now, in terms of regions, the strongest demand was in Wales, followed by the South West, the North East, South East and Yorkshire and Humber. Now, London was the area that was reported as showing the weakest tenant demand, but actually looking at what we're hearing in the market at the moment, this is now changing as London opens up. So there have been lots of people who have moved away from the area, gone to stay with family over the last 12 months, who haven't been renting in London, but there's really, really strong reports now of the demand for rental properties in London really starting to increase again, which is obviously really encouraging. And there you have it, another busy week in the world of buy-to-let lending. I hope you all found that really helpful. Thank you as always for joining us, and as always, if you do have any questions, please do give us a call 0345 345 6788. I will catch you next week. Let's all pray for some better weather. I think we're all a bit sick of this doom and gloom weather we're having at the moment. So yeah, let's hope that next week I'm talking to you with the sun shining outside the window. But until then, do look after yourselves, and I'll catch you next time.